Wolfe Research upgrading Robinhood to outperform and boosting its price target to 29 a share. And joining us now is Steven Chubak, Wolfe Research Managing Director. Steven, it's good to see you. So it sounds, Steven, like you hosted a dinner with the company's CFO. You must have liked what you heard, Steven. You go to outperform on the name, targets 29. How come, Steven? Let's talk big picture. Why do you think this is a name to buy here?
Yeah, well, first off, thanks for having me on the show. Look, I want to give some different perspective because Robinhood is predominantly covered by fintech analysts. I'm actually a financials and banks analyst by trade. But really what's underpinning our thesis, what we're looking for is durable earnings growth, upside to GAAP earnings. So forget the non-GAAP adjustments, underappreciated growth levers and a reasonable valuation. And so we came away from the dinner, quite constructive, just given there's a lot of growth runway ahead for this company. As we started to underwrite some of the levers that they could pull on the crypto side, active trader, expanding internationally, our estimates shook out 70% above the street, 70.
Wow.
And so it's very rare that we see that mind the gap, so to speak, or that upside relative to street numbers, where effectively the analyst community is not modeling any growth over the next 2 years. So definitely a lot of room for them to surprise positively.
Yes, Stephen, what do you think they're missing? What do you think the street's not seeing when it comes to Robinhood? What are some of those growth levers that you would zero in on?
Well, I think the most important component is actually expenses. So there is a tendency to focus on a lot of the brokerage metrics. But what's really going to drive the earnings growth from here is the fact that they have a highly leverageable expense base, where our expectation is that 90% of their expenses are fixed. They are going to see 75% incremental margins. So for every additional dollar of revenue, you're going to have 75 cents of that dollar fall to the bottom line. And it's that operating leverage that people are not adequately reflecting in numbers. And that's really the biggest source of upside. But even in terms of revenue momentum, they're growing organically at 20%. They're growing accounts at 5%. And that supports 20% revenue growth roughly. So as you start to think about that earnings growth algorithm, they're going to grow earnings at 30% annually. And the street is not reflecting any growth over the next 2 years.
You look, though, at this chart here, Steven. I mean, what a move already, right? I mean, the stock's up about 75% this year. It's up about 130% over the last 12 months. I mean, how does valuation look to you at these levels?
Yeah, it's a good question. I'm glad that you asked, because I think it's important to really parse what's driven some of the outperformance over, and let's just use the year-to-date number of 74%. It's exclusively driven by estimate revisions. There has been no multiple expansion for this company. I cover 28 names. There are only 2 that have actually seen multiple contraction, and Robinhood has seen no multiple expansion despite 74% gains in the stock price. And so that's a really key differentiator. It's all been driven by improving fundamentals. It's not a function of a higher multiple. And so it's a much higher quality source of price strength that I don't think is adequately contemplated by most folks. And so for us, so long as estimates continue to get revised higher, this stock is going to continue to rally. And that's really what the data is showing us. The stock price is 91% correlated to estimate revisions, and we expect that estimates are going to be revised 70% higher by 2026.
One funny little part of your note, I have to say, Steven, was when you said what this upgrade is not. You said it's not a bullish view on crypto price appreciation, meme resurgence, or anything roaring kitty. So their growth, those estimates, are not contingent on sort of these various zeitgeisty things that come into the market.
That's exactly right. For us, it was really important that we could identify drivers that are durable and sustainable to drive that growth. The fact that there's going to be an occasional meme frenzy, or we're going to go through a crypto winter, we're really trying to normalize for all those factors. So normalizing for activity rates, normalizing for account growth, normalizing for organic growth. What does that mean in terms of earnings growth potential? And again, it supports an algorithm that leaves our estimates 70% higher than where consensus is today. And so long as those estimates get revised higher again, this stock is going to continue to outperform. There's been a lot of noise on the regulatory front. There's been a lot of noise on the retail front with Wall Street Bets and the like, and Roaring Kitty. That's all noise to us. That did not factor into our thinking at all here.
Steven, thanks so much. Interesting stuff. Good to get your insight.